Hello, guys. Very warm welcome to all of you. I believe my audio and video is clear to all of you. Please confirm in the chat box. Is my audio and video clear to all of you? Come on, guys. Audio and video clear, everyone? Okay, thank you. Now, a warm welcome to all of you in the FR revision course. Now, let me first of all give you a basic introduction about this course, and then further we can move ahead in this. Okay, now this FR revision course, first of all let me tell you, it's a paid course. It's not a free course, it's a paid course. Okay, uh, it will be a total of 45 to 50 hour course, out of which we will be taking first two sessions live on YouTube. Okay, today's session will be live on YouTube. Tomorrow's session will also be live on YouTube. Okay, now let me tell you about this batch first of all, and then definitely we can start the course also. Okay, now see, understand, in my opinion, there are three pillars of success. It is what I assume. Okay, there are three pillars, mandatory pillars of success. Three things are required to succeed in any exam which you appear. Okay, and they are: point number one is conceptual clarity. Point number two, point number two is practice. And point number three is mock tests. So now what I have done is, in this FR revision course, I have tried to cater to all three of these and additionally few more things. Sir, what all things are covered in this revision course? So what I will be doing is, I will be taking up 25 hours of live revisions. Okay, it will be of 2.5 hours per day for 10 days. For 10 days. And it will be completely live. This will be live. Additionally, you will get access to practice of section A questions, section B questions, and section C questions. Okay, so these three questions will be discussed in the practice sessions. Now, as part of mock test, there will be 6 mock tests. 4 will be block-wise mock tests. 4 will be block-wise mock test, and 2 will be full-fledged mock tests. And 2 will be full-fledged mock tests. Okay. So now, out of which we will be conducting this 10 days. Out of this 10 days, we'll be conducting first 2 days as live on YouTube. For the rest part, you need to enroll. Okay, first 2 days will be live on YouTube, today and tomorrow. Now, sir, are you giving only this much? Are you giving only this much? Nah, re baba. No. We are giving something more. Sir, can you please tell me what else are you giving? I will tell definitely, but you are watching the session and not liking the session. Not at all good. Please, all of you, come on, all of you, please subscribe the channel and like the video. Okay, please like the video, all of you. Come on, guys. Come on. Okay, now. So what I have done is, I have went through your BPP kit, Kaplan kit, study hub, practice platform. Okay, and I have tried to summarize all the study resources that is available to you, and find out, and with my experience also, and find out what are the mistakes which a student makes in their preparation journey. Okay, so while giving you the conceptual clarity of revisions, I will also discuss, with you the mistakes. Do you want to see how exactly? I'll show it to you. Just give me a minute, please. I'll show it to you. Like, for example, come here. See, exam focus point. So these are the mistakes, common mistakes which you can do in your exams. Okay. Plus, not only this, see, what I have done is I have taken up numerous examples to help you understand the concepts. Okay, numerous examples will be there to help you understand the concepts. Okay. Now it will, but yes, please understand, it will be a revision batch. Okay, so wherein we will revise all the concepts, okay, in 25 hours practice and mocks. Okay, now for mocks, sir, how will you evaluate mocks? So let me tell you the evaluation strategy for the mock. So for after every mock, we will be conducting a evaluation session. After every mock, we'll be conducting a evaluation session. Okay, wherein I will discuss all the concepts, all the questions that were asked in the mock test. I will be discussing all of them. Okay, now if you have any queries in that, you can discuss that with me definitely. Now, if in the mock test there is any question, if in the mock test there is a question on, you can say, let's suppose, interpretation of financial statements. If in the mock test there is a question on interpretation of financial statements, then for that question definitely I'll discuss that in evaluation session, but additionally I'll be sending a voice note wherein I will give you a feedback on how well you can improve your answers on interpretation. I believe this is what we will be providing as part of FR revision course. This is what we will be providing. Okay, now one additional thing is, one more thing I have done an examiner report analysis. I have done an examiner report analysis. I have done an examiner report analysis and of last 10 exams. Of last 10 exams. So I will be conducting a session. Wherein I will discuss the examiner report analysis as well with you guys. Okay. Now, so this is what we'll be providing. Now, all the notes of this session will also be provided to you guys. Okay, after every session, to the enrolled students, the notes of the session will also be provided to you guys. Okay, now having discussed all the features and the benefits of this batch, now we are moving on to the revisions. And sir, can you please share the schedule, how exactly you will be helping us in revision? Definitely, yes, I can share the schedule also with you. Just a minute. I have made a schedule also for you guys, so I can share the schedule. This is the schedule. So today is 28th of October. Okay, so today we are discussing tangible non-current assets. Okay, so we will go as per this schedule, 10 days, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 10 days plan. Okay, yes, the material will be shared to all the students who are enrolled for the batch via Google Drive. Okay. Sir, how will you help us practice the questions? Definitely, I can show it to you also. For that also, just give me a minute. See, this is how we practice the questions. For example, property, plant, equipment. So what I have done is I have brought in the questions of BPP, Kaplan and Study Hub all at one place. Okay, removed all the duplicate and the similar type of questions. Okay, now what I'll do is, out of these, whatever are the unique and the important or the complex questions, I will be discussing with you guys. Okay, so this material will be shared with you as a soft copy. Now, so let us start the revisions now. For the first chapter, that is property, plant and equipment. Come on guys, tell me, are you in for it? Come on guys, shall we start the session? Come on, tell me please, shall we start the session? I can't see the energy in you guys. Come on guys, show me some energy. Okay, chalo. So today, as per the schedule, we have to study tangible non-current assets. Okay, as per the schedule, the first topic that we have to study is tangible non-current assets. Now, in tangible non-current assets, particularly the chapter which we have to study, the standards which we have to study is uh, IAS 16 on property, plant and equipment, IAS 40 on investment property, and IAS 23 on borrowing costs. Okay, starting with IAS 16 on property, plant and equipment. Please understand. Now understand, as we all know, property, plant and equipment is an asset. Okay, so let us dig deep into it. Okay, so understand, in SOFP, statement of financial position, what all things comes up? Three things: assets, equities and liabilities. Okay, so let's ignore equities and liabilities as of now, because property, plant, equipment is not an equity, not a liability, it's an asset. Now, assets are of two types: non-current assets and current assets. Okay. Now, property, plant, equipment is not a current asset, so ignore it off. Coming to non-current assets. So, non-current assets are also of multiple types. One is tangible non-current assets, intangible non-current assets, non-current financial assets, and other non-current assets. Now, property, plant and equipment is a non-current tangible assets. What is the meaning of tangible? Something which has physical substance. So let's ignore intangible, let's ignore financial, let's ignore others. Come to tangible non-current assets. Now, in tangible non-current assets, we have two type of assets, that is property, plant and equipment, and investment property. Now comes the question, how exactly are you going to differentiate between property, plant and equipment and investment property? Okay, now understand property, plant and equipment. So let us understand first of all the definition of property, plant, equipment and investment property, and going further you will understand the difference between the two. So first of all, let us understand what is PPE, what is IP, and then what is the difference between the two. So understand, PPE, as the name itself says, it's a tangible asset. It's a tangible asset, but investment property is also a tangible asset. Okay. Now, property, plant and equipment is a tangible asset which is held for either of these three purposes. What are the three purposes? Held for production of goods or supply of services. Like for example, this laptop, it's a tangible because it does has physical substance. This laptop is held by me for taking the classes, that is supply of services. So it's a property, plant and equipment. It's a property, plant and equipment. So property, plant and equipment is a tangible asset held for either of the three purposes, that is production or supply of goods or services. Then administrative purposes. What is the meaning of administrative purposes? You can say the backend team. Okay. Then third comes rental to others, and the life of these assets should be more than one period. That is when it will become non-current. So again, what is the definition of property, plant and equipment? So property, plant and equipment is a tangible asset held for either of the three purposes, that is production or supply of goods or services, rental to others, administrative purposes, and the life is more than one period. That is called as property, plant and equipment. Then comes the question, what is investment property in that case? So investment property is specifically either land, building, both or a part thereof, held for rental to others, capital appreciation or both. That is called as investment property. Confused? Let me clarify a little bit. Let me give you a little bit of clarification. Understand please. So what we can do is we can distribute the tangible non-current assets into two parts. Properties. Property. When I say property, it means what? When I say property, it means land, building, both or a part. Okay. Now understand, if it is a property or it is a plant and equipment, what is the meaning of plant and equipment? The machineries, the laptop, the mic, the mouse, These are called as plant and equipment. Okay, now understand please. If this property is held for production of goods or supply of services, then it is called as property, plant, equipment. If this property is held for administrative purposes, it is called as property, plant and equipment. Okay, but understand, if this property is held for rental to others, it will not be property, plant, equipment, it will be investment property. Now that's why what I have done here is, under property, plant, equipment definition, see what I have done here. Tangible items held for use for these three purposes, and in rental I have written other than property. Why? Because if a property is given on rental to others, it is not property, plant, equipment, rather it is investment property. So please make a note of it. If a property means land, building, both or a part thereof is given on rental, it is given on rental, then it is not a property, plant, equipment, rather it is an investment property. Okay, if the property is held for capital appreciation, then it is investment property. Now coming to plant and equipment. If this plant and equipment is used for production of goods or supply of services, PPE. Admin purposes, PPE. Rental to others, PPE. No sir, rental to others will be investment property. Come here. In the definition of investment property, it says land, building, both or a part thereof. Does it say plant and equipment? No. So if a plant and equipment is given on rental, it is property, plant and equipment. Okay, now capital appreciation. Tell me, will you purchase a laptop for capital appreciation? Will you do that? No. These are depreciating assets. They don't appreciate in value. Okay. So this is what is the meaning of property, plant and equipment and investment property. And I believe now you are able to understand the difference between PPE and investment property. I believe it is clear to all of you. Okay, chalo. Now moving up further, guys, all of you are asking notes. So as I have already told you guys, and I'm telling it again for that matter. So please understand, the notes of this session will be made available to you right after the session as part of Google Drive to the enrolled students. Okay, now first two lectures, that is today's lecture and tomorrow's lecture, will be available on the YouTube. Okay, it's a total of 50-hour course, 45 to 50-hour course divided into 25 hours of, you can say, revisions and some 25 hours of practice, and you can say further mock tests. Now moving on to the next part. I believe you have understood the meaning of property. I believe you have understood the meaning of property, plant and equipment. Now moving on to the next part. This definition of bearer plant takes its stand from IAS 41 on agriculture. Okay, let me just add here. Just give me a minute. Agriculture. So if you are aware of it, in IAS 41, when I will be teaching you IAS 41 agriculture, I say IAS 41 agriculture covers two things. One is on biological assets and one is agricultural produce. Now what is the meaning of biological assets? It means living animals and living plants are called as biological assets. Now, out of these biological assets, there is something called as bearer plant. There is something called as bearer plant, which is called as property, plant and equipment. Rest is called as biological assets in the scope of IAS 41. So this bearer plant will fall under the scope of IAS 16. This bearer plant will fall under the scope of IAS 16. Now, so what is the meaning of bearer plant? So bearer plant is a living plant is a living plant used in the production or supply of agricultural produce with a produce more than one period and remote likelihood of being sold as agricultural produce. What is the meaning of this? What is the meaning of this? Let me explain the meaning. Let's suppose we have a mango tree. Let's suppose we have a mango tree. Now tell me, what is the life of mango tree? Definitely more than 1 year. Definitely more than 1 year. Okay. Now, is it a living plant? Yes. Mango is a living plant. Mango is a living plant. Yes. Mango tree is a living plant. Yes. Now, mango tree helps us get the agricultural produce, that is mangoes. Okay. Will we get mangoes from the mango tree only for 1 year? No, we get every year mangoes. We get mangoes every year. Okay. Now tell me, do we cut the mango tree itself and sell it off? No, there is a remote likelihood that we'll cut the mango tree itself. No, we don't cut the mango tree. Rather, we pick the mangoes. We pick the mangoes. Okay. Now that's what is called as a bearer plant. So trees like mango tree, guava tree, all these are called as bearer plants. All these are called as bearer plants, and they are covered in the scope of IAS 16 on property, plant, and equipment. Any living plant other than bearer plant are covered as part of biological assets in the scope of IAS 41 agriculture standard. Now, this is a very theoretical point from an exam perspective, a very theoretical point from an exam standard. Okay. Now, a recognition principle. See, so far we understood, guys. Come on, guys. Give me a please text here in the comment box. Are you understanding everything? Come on, guys. Come on. Please tell me. Are you guys understanding everything? Is it a quick recap of all the concepts? A sort of brush up of all the concepts? Tell me. Is the speed okay? Come on, guys, please tell me. Is the speed okay for all of you? Wonderful. Going on to the next part. Measurement, recognition principle. Now understand what is the meaning of recognition principle. So standard says that, see, when we studied the definition of property, plant, equipment, we evaluated whether this asset is a PPE or not. We were evaluating whether this asset is a PPE or not. Under recognition principle, we are evaluating whether this PPE can be recognized in your books of account or not. Now, what is the recognition principle? So standard says that it is probable that the future economic benefits should flow to the entity and cost should be measured reliably. If both these conditions are satisfied, then in that case we can definitely say that the property, plant, and equipment can be recognized in the financial statements. Sir, what if the recognition principle is not satisfied? Then whatever amount we have spent on the property, plant, equipment, that will be expensed off to P and L. That will be recognized as an expense to P and L. So what is the meaning of recognition in the financial statements? Meaning thereby, if both the recognition principle, if both the conditions are satisfied, then we recognize the property, plant, equipment in statement of financial position, and we depreciate the property, plant, equipment over its useful life. Okay, because we are getting the benefits over useful life. But if either of these conditions are not satisfied, in that case, whatever amount we have spent on the property, plant, equipment, that will be expensed off to P and L. That is, it will not be recognized in SOFP as an asset. It will not be. Now coming on to the next topic, that is measurement principle. How will you measure the property, plant, and equipment? So now understand. In measurement principle, there are two things: initial measurement and subsequent measurement. Okay, let's not look into the notes. Let's discuss initially first of all. Okay, let's have a quick overview of the measurement principle. Let's have a quick overview of the measurement principle first of all. Now, initial measurement. Tell me, how do you initially measure the property, plant, equipment? How do you initially measure the property, plant, equipment? It is measured at its cost. It is measured at its cost. Okay, now definitely we have to study the meaning of cost. But before that, what is the subsequent measurement? That is, what is the treatment over the life of the asset? What is the treatment over the life of the asset? Now understand, how do we subsequently measure the property, plant, equipment? So standard gives us an option, either to use the cost model, either we can use the cost model, okay, or we can use the revaluation model. Okay, we have a choice. We have a choice of cost model or revaluation model, and the choice of cost model or revaluation model is based on tell me what is based on tell me what it is based on class of asset basis. Sir, what is class of asset? Assets of similar nature and similar purpose are grouped into one class of assets. Okay, now let us discuss here. Okay, further measurement principle. So initial measurement will be done at its cost. Comes the question, what is the meaning of cost? What is the meaning of cost? So understand, cost includes what? First of all, purchase price, then what? Non-refundable taxes or import duties. Sir, what if the tax or the import duties are refundable? If they are refundable, we will not add them to the cost. If they are refundable, we will not add them to the cost. If they are already added, we will remove them from the cost. Okay, we will remove them from the cost. Now, going further. So now, what is the meaning of cost? Purchase price plus non-refundable taxes minus trade discounts or rebates. Sir, what if it is a cash discount? So if there is a cash discount that we have received on purchase of a property, plant, equipment, that cash discount will be recognized as an income in P&L. Okay, we will not adjust the cash discount here. Okay, so purchase price plus non-refundable taxes minus trade discounts or rebates, then borrowing cost as per IAS 23. Do you remember, guys? We if we incur any borrowing cost on a qualifying asset, that borrowing cost is capitalized to the cost of the qualifying asset, right? So that's what we are doing here. Borrowing cost on qualifying assets is also capitalized to the cost of the asset, plus any directly attributable cost. I've always mentioned, guys, whatever cost that you incur to bring the property, plant, equipment in the location and condition to use the asset is capitalized to the cost of the asset. Let's suppose I purchased an air conditioner from a shop. Now, to bring the air conditioner from shop to my office, I will incur some delivery cost, transportation cost. I will have to capitalize this cost to the property, plant, equipment. Now, after the air conditioner reaches my reaches my office, I will have to get the air conditioner installed. So I will incur some installation costs. So I will have to capitalize this installation cost also as part of the cost of the asset. Okay, so that's why it says any directly attributable costs incurred to bring the asset to the location and condition for the intended use by the management is capitalized to the cost of the asset. Now it says last one is present value of estimated cost of dismantling, removing the item or restoring the site on which it is located. Okay, now understand what is the meaning of this one. So it is talking about present value of estimated decommissioning, removal or restoration costs. Okay, now, so why present value? Because they are not incurred on the date of purchase. Okay, now please understand here, I have taken up an example. Please understand. Let's suppose this is the date of purchase. Let's suppose this is the date of purchase. Are we incurring decommissioning, removal or restoration cost here? No, we are incurring here. So there is a time gap. Hence we have to compute the present value and capitalize to the cost of the asset. We have to compute the present value and capitalize to the cost of the asset. Okay. Harmeet Kaur is asking, carriage is added or not? So understand, carriage are of two types. Okay. So if the carriage is in the nature of bringing the asset to my premises, means it's a transportation cost, means it's a cost incurred to bring the asset to my intended location. Hence it will be capitalized. But let's suppose if carriage is incurred to relocate my asset from my premises to some different premises, will that be capitalized? No, that will not be capitalized. So carriage in the nature of transportation cost will be capitalized, but carriage in the nature of relocation cost will not be capitalized. Okay, now, so this is the meaning of the cost of property, plant and equipment. And also I have told cash discount is not capitalized, okay, is not adjusted with the cost. Rather the same should be recognized as an income in P and L. Now understand, standard says that once the asset reaches the intended location and intended condition, capitalization ceases. You cannot capitalize any further cost beyond that. So capitalization ceases when the item is in the location and condition necessary for it to be capable of operating in the manner intended by the management. Let's suppose I purchased an AC and the AC got installed in my office. Now after that, if I'm incurring any repairs expense, maintenance expense, can I capitalize that to the cost of air conditioner? No, I cannot capitalize that. Okay, now come to this directly attributable cost. Standard has been so considerate for you guys. So standard is giving you what all are the inclusions and exclusions for this directly attributable costs. An example of it is given. What are the example given? See here. Employee cost for the construction of property, plant and equipment. Okay, now Sakshi has a query here. Before starting this topic, let me discuss the query of Sakshi. Capitalization ceases. Note, please repeat. So understand, Sakshi. Let's suppose I purchased a let's suppose I'm giving you a very realistic example. Okay, let's suppose I purchased a property. Okay, I purchased a flat, and the flat was only simple, only buildings were there. Okay, only walls were there, no other thing were there. So I purchased the property, flat. Let's suppose I purchased the flat for 1 million. After the flat was purchased, okay, I got the interior works done in the flat. Okay, the interior work was done in the flat, and to get the interior work done, I incurred, let's suppose, 0.5 million again. 0.5 million again I incurred. Interior work was done. Completed. Interior work was done and completed. Okay, now my flat is fully complete and the people can come and stay in that. Okay, family members can come and stay in that flat. So we will say now the flat has reached its intended location and condition, means it can now be used. It is available for use. Now. Once the asset becomes available for use, you cannot capitalize any further cost to the cost of flat. Okay, let's suppose after the asset becomes available for use, now you want to get some maintenance done for the flat. Okay, every month you want to do some maintenance, every quarter you want to do some maintenance. Will you capitalize those maintenance costs? No, you cannot capitalize those maintenance costs. Okay, you cannot capitalize those maintenance costs. Now Chirag is asking, sir, what about maintenance cost to keep it in use for 3 years or more? Now if you have incurred any maintenance cost which will hold good for next 3 years, then ideally what we do is we recognize the maintenance, these type of maintenance cost as prepaid expense, and expense it off to P&L over next 3 years. Okay, over next 3 years. Understand, Chirag, why this is happening? Because standard says that when you incur any maintenance cost, is this cost giving me some extra benefits? No, it just maintains the asset. It doesn't give me any extra benefit. If it doesn't give me any extra benefit, will I increase the value of the asset? No, I will not increase the value of the asset. Rather, but I will definitely get the benefit of maintenance cost over the next 3 years, right? Because I have paid everything in advance and I will get the benefit over the next 3 years. So definitely I will recognize it as prepaid costs and amortize over the 3 years. Now, again, to add on to your point, Chirag, if the maintenance cost that you have incurred, okay, is of the nature which actually increases the benefits of the asset, then yes, we can capitalize the maintenance cost as part of the cost of property, plant and equipment and depreciate it over the next 3 years. Okay, but if question is silent, then assume maintenance cost will be expensed off to P&L, or recognized as a prepaid expense. Okay, if the question specifically says that the maintenance cost that we have incurred increases the benefits of the asset, then yes, you can capitalize it off. Okay, now moving on to the query of Shakshi, cost of testing can be capitalized. Yes, cost of testing can be capitalized to the cost of the asset. See here, it is written also. Testing cost is capitalized, includes directly attributable cost, includes testing costs, includes employee costs, includes cost of site preparation, includes initial delivery and handling cost, includes installation costs, includes professional fees on acquiring the asset, includes testing costs, includes directly attributable overheads. Now understand one more point, guys. In the exam, the examiner will try to bluff you. How exactly? They will write allocated overheads. So understand, if the question says overheads, you have to search for the term directly attributable overheads. If it is written, then capitalize it to PP. But if the question says general overheads, admin overheads, allocated overheads, then do not capitalize it to the cost of the asset. Rather, expense all this to P and L. Expense all these to P and L. Expense all these to P and L. Expense all these to P and L. Is it clear, everyone? Come on, guys, tell me. Okay. Now, so we have discussed the cost of PP as purchase price, non-refundable taxes minus trade discount, add borrowing costs. This one we'll discuss in depth in the chapter of IS 23. Directly attributable cost also discussed. Now this dismantling cost, let us discuss via example. Understand, dismantling, removal or restoration costs. Understand the obligation. Many times in the exam, the question will say there is a legal obligation to incur dismantling cost. You will say, oh, it's an obligation, we have to capitalize. Very good. Many times the examiner will try to bluff you by saying, there is no legal requirement to incur these costs, but still the entity wants to incur these costs. You will say, oh, there is no obligation, why to capitalize? So understand, I have written here, obligation can be legal, can be constructive, can be contractual. Sir, what is the meaning? Legal means by law gives you an obligation. Constructive means Law doesn't give me an obligation, but I have taken an obligation on myself. Okay, no one gives me an obligation. It is my wish to take this obligation. It is called as constructive. I have taken an obligation on myself. Contractual means by virtue of any contract. So obligation can be either of these, irrespective of whether it is a legal or constructive or contractual. You have to capitalize the dismantling cost, removal cost, or decommissioning cost as present value to the cost of the asset. Sir, how exactly we have to do the treatment of it? Understand. Capitalize at present value of estimated costs incurred at the end of the useful life. When do you have to capitalize? On the date of initial recognition. So what is the initial accounting treatment of the same? Capitalize the amount of provision to the cost of the asset at its present value, and the entry will be asset account debit to provision for DRRC. Subsequently, what will happen? We will depreciate this asset over useful life. Now, what will happen to this provision? We'll unwind the provision. And record finance cost. And at the end of useful life, we'll pay off the obligation. At the end of the useful life, we'll pay off the obligation. Let us understand this one with the help of an example. Guys, are you understanding everything? Can you please confirm in the chat box? Are you understanding everything? Can you please confirm in the chat box? Come on, guys, please tell me. Now, example number 1, provision for DRRC, decommissioning, removal or restoration cost. On 1st January 2004, XYZ Co. purchased an oil rig for $10 million. So this is the purchase price. Incurred installation costs of 2 million. So this is a directly attributable cost. Okay, now A Limited estimates decommissioning and restoration cost of 6 million to be incurred at the end of useful life of 3 years. So if you have to draw the diagram, you will say you have incurred 10 million here, you have incurred 2 million here, and you will incur 6 million here. Now, since there is an obligation, we have to compute the present value and capitalize to the cost of the asset. Now tell me, what will be the journal entry here? So now, what is first of all? Let us compute the present value of 6 here. So present value, the discount rate is given as 10%. Discount rate is given as 10%. So the amount will be 10 plus 2 plus 4.51 as the present value. Total comes to 16.51 million. Guys, here I assume that you know how to compute the present value. If you don't know how to compute the present value, no need to worry at all. What I will do is, as part of your course, I will upload one lecture wherein I will discuss all the basics of financial reporting and SBR. Okay, I will upload a basics class. Okay, wherein we will be discussing how to pass the journal entries, how to compute the present values, what is the meaning of financial statements, what are the components of financial statement, what are the elements of financial statements. So all the basics of FR and SBR are covered as part of that lecture. Okay, I will add it to your course. Now, so understand, what is the value of your asset? 16.51. Now, how to pass journal entry? So you will recognize the asset at 16.51. Now tell me, out of 16.51, how much you have already paid? This much. So to bank, 12. Now tell me, this 4.51, have you already paid? No. When will you pay? After 3 years. So it's a provision of 4.51. Sir, why are you saying provision? Why not liability? Why provision? Because understand, this amount of 6 million is not final. It's an estimated amount. It might be the case that at the end of 3 years, we have to pay 7 million, or we might have to pay 5 million or 4 million or 10 million even. right? We have standing as on here, we have just estimated that what will be the amount that will be incurred here. Okay, we have estimated. That's why we are writing provision for decommissioning, removal, restoration costs 4.51. 4.51. Okay, so this is a journal entry. Now, subsequently, what will happen? We will depreciate the oil rig over 3 years. We'll unwind the present value of the provision over 3 years, and at the end of year 3, that is at the end of useful life, we'll pay off the decommissioning costs. How exactly? Understand, please. I have written the journal entries here. Depreciate oil rig. So at what value have we recognized the oil rig? 16.51. 16.51. So 16.51 over 3 years is 5.50, 5.50, 5.50. So entry will be depreciation expense account debit to oil rig 5.50, 5.50, 5.50. Okay. This depreciation expense will go to P and L. Now, further, you have to unwind the present value over 3 years. So what is the provision that you have recorded here? 4.51. How to unwind? How to unwind? So unwind using the same rate which you used to compute the present value. So what was the rate? 10%. So what is the opening provision here? 4.51. So what is the finance cost here? 0.45. So what is the liability? 4.51 plus 0.45 is 4.96. So what is the finance cost for year 2? 4.96 ka 10%, that is 0.50. So what is the liability at end of year 2? 4.96 plus 0.50 becomes 5.46. What is the finance cost for year 3? Again, 10% of 5.46, that is 0.54. So what is the liability at year end 3? 5.46 plus 0.54, that becomes 6, and we'll pay off 6 at year end 3. Okay, now this finance cost will go to P and L. So journal entry will be finance cost account debit to provision for DRRC, and this finance cost will go to P and L. Okay, now the journal entry to pay off at year end 3, will be provision for DRRC is a obligation, a liability which we debit and pay off 6 to bank. Tell me guys, are you understanding this example? So basically what we did on the date of initial recognition, we capitalized the decommissioning cost at its present value to the cost of the asset. Subsequently, we depreciate the asset over its useful life, and we amortize or unwind the provision using the same rate which we used to compute the present value. Now, while unwinding, we record finance cost. Both the depreciation and the finance cost will go to P and L. And there is a question also on this. Which I have discussed in your practice batch. Just a minute. In your practice sessions, which you will get on enrollment, just I'll show it to you. There is a question, exact question on this one. See here. See this question. On 1st July 2004, experimenter opened a chemical processing plant. The plant was due to be active for 5 years. When it would be decommissioned, right? The cost of decommissioning is this much. Okay, discounting factor is this much. What is the total charge to the P and L? So it will be finance cost plus depreciation. It will be both. Okay. So these questions are discussed as part of practice sessions. Now, so I believe initial measurement is clear to all of you. Now moving on to the subsequent measurement. Subsequently, as I told, there is an option to measure the asset at cost model or revaluation model. Okay. Under cost model, we depreciate the asset over its useful life. But under revaluation model, we fair value the asset at regular intervals. Okay. Now, the choice of cost model or fair value model is available on class of asset basis. What is the meaning of class of asset basis? Let me show it to you. So please see here. Understand? Let's suppose a entity called as Google has three class of assets: property, plant, equipment, office, furniture, and building. Meaning thereby all the buildings are of similar nature and similar purpose buildings are grouped into one class. It can be the case that there are two class of building. One building is for factory purpose, one building is for office purpose. So even though both the building, the nature is same, but since their purpose is different, they will become two class of assets. Okay, so now, assuming there are three class of assets: plant, machinery, office furniture, and building. Entity has opted that for plant and machinery will adopt cost model, for office furniture will adopt cost model, but for buildings will adopt revaluation build model. So in that case, all the plant machineries should be at cost model only. It can't be the case that we can say, no, plant machinery 3, let's keep under revaluation model. Can we do that? No, we can't do that. Okay, if office furniture is under cost model, means all the office furniture will be under cost model. It can't be the case that we'll say, okay, office number 2 under cost model, office number 3 under cost model, but office number 1, office furniture number 1, it can be under revaluation model. No, it can't be the case. If the buildings are under revaluation model, then all the buildings should be under a revaluation model. It can't be the case that building 1 is revaluation, building 3 is revaluation, building 4 is revaluation, but building 2 cost model. No, can't be the case. Can't be the case. Okay, so this is what is the meaning of class of asset basis. Now, what should be the frequency of revaluation? Paul, please understand what is about provision. So provision will get paid off at year end 3. See, provision will get paid off at year end 3. Provision will get paid off at year end 3. Okay. Just to show the presentation in financial statements, since you guys have asked, I'll show it to you. In SOFP, how will we present over 3 years, and in P&L, how will you show over 3 years? Let me show it to you. Copy. I believe that will give you a fair understanding of the concept. Now understand. Year end 1, year end 2, year end 3. Your asset initially was 16.5. 51 minus 5.5 is 11.01. 5.51 and then nil. Your provision for DRRC initially it was 4.51. At year end 1 it becomes 4.96. At year end 2 it becomes 5.46. At year end 3 it becomes 6 and then ultimately gets paid off, so it becomes nil. Okay, now in P and L you will record finance costs on unwinding of the provision. First year it will be 0.45, second year it will be 0.50, and third year it will be 0.55. And then also you will record depreciation 5.50, 5.50, 5.50 is a depreciation. So this is how it will be presented in financial statements. I believe, Paul, it is clear to you now. Okay, moving on further. Please confirm, is it clear, everyone? Please confirm, is it clear, everyone? Understand also that this is shown as part of non-current asset. and this is shown as part of non-current liability. Okay. Clear, everyone? Is it clear to you, Paul? Okay, let's move further. So we've discussed how to select whether cost model or revaluation model. Now comes frequency. So standard says that standard is asking, tell me how do you want to revalue or when exactly you want to revalue your asset. If you have selected a revaluation model, when exactly should we revalue? So now the answer to that is when the entity believes that the carrying amount of the asset differs materially from its fair value. When the carrying amount of the asset, that is when the book value of the asset differs materially from the fair value of the asset, then we have to do the fair valuation. In that case, we have to do the fair valuation exercise. Now, standard further also goes on to state that generally it has to be done once in 3 to 5 years. Okay. Now, on a circular basis, you can do the revaluation once in 3 to 5 years. Further, if fair value of an asset is significantly volatile, if the fair value of the asset is significantly volatile, okay, see here, it is significantly volatile, then annual revaluation might be needed. Okay, in that case. Now, so this is the frequency of revaluation. Now comes the question of revaluation approach. Can I explain this revaluation approach using an example? Why not? So there are two types of revaluation approach. Let me discuss it with the help of an example. So first of all, let me take up an example. So let's suppose the cost of the asset is 100. The accumulated depreciation is 55. The accumulated depreciation is 55. Thereby, the carrying amount of the asset is 45. The carrying amount of the asset is 45. And the fair value is 65. So you have to revalue from 45 to 65. Comes the question, how exactly are you going to revalue? So for that, standard says that there are two approach. Approach number one is depreciation elimination approach. Guys, can you please tell me, where do we record revaluation gain? If someone knows, come on guys, come on. Let me test how well do you know things. Are you able to revise it or not? Are you able to recall it or not? Come on, tell me. Where do we record revaluation gain of property, plant and equipment? Come on, tell me please. Where do we record revaluation gain of property, plant and equipment? Come on, please tell me. Very good, Chirag. Very good, Rehan. Very good. We record in other comprehensive income. So what is the approach of revaluation? See, as the name says, depreciation elimination method. As the name says, depreciation elimination method. So what we will do is, first of all, eliminate this accumulated depreciation with the cost of the asset. So what I will do here is, I will pass journal entry as accumulated depreciation account debit to asset. How much? 55. 55. So first of all, I will decrease the cost of the asset. Now tell me, what was the cost of asset earlier? 100. What was the cost of asset earlier? It was 100. After this, what is the cost of asset now? 100 minus 55 is 45. Now, what is the fair value of asset? 65. So, what is the revaluation gain? It is 20. So, the entry will be asset account debit to other comprehensive income, 2020. Now, can anyone tell me, where will this other comprehensive income reported? Where will this other comprehensive income reported in statement of financial position? Can anyone tell me, where will this other comprehensive income reported in statement of financial position? It is reported by the name of revaluation reserve as part of other equity. If you can recall, in statement of financial position, equity, there is a head called equity. Under that called as other equity. Under that there is something called as other equity, right? So under one of the components of other equity is revaluation reserve. So how it is reported? See, understand. Let's suppose this year I had a revaluation gain of 20. So I will record in other comprehensive income 20. I will accumulate in revaluation reserve 20. Next year again I get a revaluation gain of 15. So in other comprehensive income I will report 15. But in revaluation reserve it will become 35. So for the year, revaluation gain goes to other comprehensive income, but it is accumulated as part of revaluation reserve. Let's suppose here we get a revaluation gain of 12. So in other comprehensive income I will report 12, but in revaluation reserve it will become 47. I believe you are understanding this point. You know what? Many of the students are not aware of these small topics. They're not aware of it. They're not even aware of it. But in the exam, they will definitely test your knowledge on this. Okay. Now comes the next part as restatement approach. Now what happens in restatement approach? So under restatement approach, what we do is, we say, first of all, we have to compute what is the percentage increase from 45 to 65. Tell me please. 65 divided by 45. It is 144.44 percentage. Right? So now the standard says that please increase cost and ACCA also by 140, increase it to 144.44 percentage. Okay, see, it is this much percentage. So you can say it is plus 44.44 percentage. Okay, that is 65 minus 45 divided by 45. It is 44.44 percentage, right? So here, what is the percentage? What is the increase? 44.44. It becomes 144.44. ACCA will be how much? 55 into 0.444. It is 24.44 plus 24.44. Here it will be 79.44. So net it is 65. So what is journal entry? So standard says that, see, your asset increased by how much? 44.44. Understand, your ACDEP increased by how much? 24.44. So the net impact is how much? 20. This will go to other comprehensive income. So understand, the impact on other comprehensive income and revaluation reserve remains the same. Just that the way of passing the journal entry will change. Just that the way of passing the journal entry changes under these two approaches. Is it clear, everyone? Is it clear, everyone? Come on, guys, please tell me. Is it clear, everyone? Okay, that also we'll discuss. Tell me, is this clear, everyone? Okay, chalo. Now, coming to the treatment of revaluation gain or loss. Understand, guys, the choice of cost model or revaluation model was on entire class of asset basis, right? Was on entire class of asset basis. Okay, Harmeet Kaur has a query. She is saying, how did I compute this percentage? Just see what is the percentage increase. So what is the amount of increase? 20 out of 45 into 100 percentage. Tell me how much? 20 divided by 45 is 44.44 percentage is the increase. So increase 100 also by 44.44%, increase 55 also by 44.44% increase. Okay. These two are absolute amounts. This is percentage. This is percentage. Okay. So I can say it like this. These are increased by 44.44 percentage. This is what I can say. Clear, everyone? Chalo. Now, treatment of revaluation gain or loss. Let's suppose we are doing the revaluation for the very first time. We are doing the revaluation for the very first time and we get revaluation gain. Tell me, where will we record the revaluation gain? Where will we record the revaluation gain? So the revaluation gain will be recorded in other comprehensive income. Simple. Subsequently again we get revaluation gain. Where will you record that? Other comprehensive income. Very simple. But understand, first time you got revaluation gain, you recorded in other comprehensive income. Second time you got revaluation loss. Second time you got revaluation loss. Where will you record? So standard says that adjust the loss with just a minute. I'll simple say other comprehensive income to the extent there is a balance in revaluation reserve. Any excess will go to P and L. Any excess will go to P and L. Let me explain this with the help of example. First year we did a revaluation gain and we got revaluation gain of 20. We got a revaluation gain of 20. Tell me, where will we record this revaluation gain? So we'll record it in other comprehensive income 20 and revaluation reserve 20. Second year again you got a gain of 15. So where will you record other comprehensive income 15 and revaluation reserve 35? Again, you got a gain of how much? 12. So where will you record other comprehensive income 12? Other comprehensive income 12. Now revaluation reserve becomes 47. Now let's suppose you get a revaluation loss of 55, not 55, 50. 50. So now tell me, what is the balance in your revaluation reserve? 47. So what will you do? Other comprehensive income negative 47. Now your revaluation reserve becomes what? Nil. But still you have a loss of 3 remaining. Still you have a loss of 3 remaining. So where will you record that? P and L 3. P and L 3. Is that clear, everyone? Is that clear, everyone? Okay. Now, moving on to the another example. First time we did the revaluation. And it's a revaluation loss. Now apply your logic. What is the treatment of revaluation loss? Adjust to the extent there is a balance in revaluation reserve. Tell me, if we first time we did the revaluation and there is a revaluation loss, is there any balance in revaluation reserve? No. So where will you record this? P and L. Second time you again did revaluation. Okay. Now, and you got a revaluation loss. Where will you record? P and L. Means first time revaluation loss, P and L. Second time revaluation loss, P and L. Now, but first time revaluation loss, P and L. Second time revaluation, there is a revaluation gain. Then what will you do? So standard says that P and L. You will record this in P and L. You will record this revaluation gain in P and L to the extent revaluation loss was recognized in P and L. Any excess will go to other comprehensive income. Let me explain using example. So first time we did revaluation and we got revaluation loss. First time we did revaluation, we got revaluation loss of how much? 20. So where will you record this loss of 20? P and L. 20. Because we do not have any balance in revaluation reserve. Second time you did revaluation, again a loss of 15. Where will you record? P and L 15. Third time when you did revaluation, you got a revaluation gain of 50. You got a revaluation gain of 50. Not 50, 44. 40. You got a revaluation gain of 40. Now tell me, where will you record this revaluation gain? So standard says that this revaluation gain will go to P and L to the extent revaluation loss has earlier been recognized in P and L. So how much has been recognized in P and L? 20 plus 15, 35. So out of this, P and L will be 35. Any excess, that is 5 excess, will go to other comprehensive income and accumulate in revaluation reserve 5. Is it clear, everyone, now? Okay, see, that's what I have written here also. Revaluation gain recognized in other comprehensive income is accumulated in revaluation reserve other equity in the statement of financial position. Sir, what is this note? Let me explain. Let's suppose, let's suppose in this year, in this year, from asset A, I get a revaluation gain of 20, and from asset B, I get a revaluation loss of 12. So can I say that net gain is 8, which can be recognized in other comprehensive income? Can I say this? Come on guys, tell me. Can I say this? Can I say this? No. The answer is clear cut. No, I cannot say this. This is wrong. Then what should be the treatment? What is the right treatment? The right treatment is this gain should be recognized in other comprehensive income, and this loss should be recognized in P and L. Why? See here. Entity cannot net off revaluation gain and loss of different assets even if they belong to same class of assets, and that's the reason why I have written here treatment of revaluation gain or loss is taken care of asset by asset basis. Asset by asset basis. Loss and gain of different assets cannot be net off, cannot be net off. Is it clear everyone? Is it clear everyone? Now comes the next topic, that is treatment of revaluation reserve. Treatment of revaluation reserve. What should be the treatment of revaluation reserve? So understand the standard says the revaluation reserve has to be transferred to retained earnings. This revaluation reserve has to be transferred to retained earnings. But comes the question when? Comes the question when? So the standard says that if the question is silent, transfer the revaluation reserve to retained earnings on disposal of the asset. Whenever you are disposing of or de-recognizing your asset, on that date, whatever is the balance in your revaluation reserve, transfer that to retained earnings. Transfer the entire balance to retained earnings. But standard gives you one more option. Standard gives you one more option. But this option has to be exercised only if question clearly mentions that. Question clearly mentions. And now what is the option given? What is the option given? Option is annual transfer. Option given is for annual transfer. Annual transfer over the remaining useful life of PPE by amount of excess depreciation. Now students generally have a misconception in their mind that okay, we have to transfer the excess depreciation to retained earnings. No, depreciation remains intact in P&L. We are not required to change the depreciation amount. No. We are required to transfer from retained earnings. Sorry, we are required to transfer from revaluation reserve to retained earnings, from revaluation reserve to retained earnings by amount of excess depreciation. Let's suppose prior to revaluation, my depreciation per year was 90. Subsequent to revaluation, since the value of the asset has increased, therefore the depreciation will also increase. Okay, so the subsequent to revaluation, depreciation per year is 120. So what is the increase of depreciation due to revaluation? 120 minus 90, that is 30. So every year we have to transfer 30 from revaluation reserve to retained earnings. We are not required to touch the excess depreciation. We are not required to touch the depreciation amount. The depreciation amount remains intact as it is in P and L. That's a mistake which almost 95% students makes in the exam. Okay, so if you are one of them, please make a note of it. And I have seen ACCA testing this point every time in the exam. Every time. And it's not only this. There are a lot of mistakes like this. Okay, which students repeat in the exam time and again. And ACCA knows that you will be repeating these mistakes, and they continue to ask in the exam. They continue to ask those mistakes in the exam. Okay, now, so what I have done is I have taken up an example on this one. I have taken up an example on this one so that you get a better clarity over the concepts. Now, example number 5, treatment of revaluation loss and revaluation reserve. Understand? So, A Limited purchased a property for 900,000. So, cost is 900,000. Life is 10 years. Life is 10 years. At the end of second year, fair value of the machine is 960. Okay. Further, at the end of fifth year, the machine was revalued to 400. Okay. Suggest the accounting treatment if the entity has a policy of annual transfer of revaluation reserve to retained earnings. See, if the question is specifying, then only we have to adopt this one. Okay. Now, so let's see how will we solve this one. Let's see that. Cost is 900, life is 10 years. So what is the depreciation per year? 90. Year end 2, what is the carrying amount? So cost is 900, depreciation will be 90 into 2 for 2 years. So 900 minus 180, carrying amount is 720, fair value is 960. So revaluation gain is 240, okay, which will be recognized in other comprehensive income and accumulated in revaluation reserve. Clear? Now, over these 3 years, two things will happen. Over these 3 years, year 3, year 4, year 5, two things will happen. Tell me what? One, you will depreciate the asset over the next 8 years. You will depreciate the asset over the next 8 years. That is 960 by 8, depreciation per year will be 120. Point number 1. Point number 2, since the policy is annual transfer, so you will keep on transferring an amount from revaluation reserve to retained earnings every year. Cool? Chalo. Now let's come to year end 5. What is the carrying amount? So depreciation per year is 120. So 120 into 3. What is the total depreciation? 360. Carrying amount here after fair valuation is 960. So 960 minus 360. So carrying amount will become 600. Right? Carrying amount will become 600. Fair value is 400. So what is the loss? So revaluation loss is 200. Comes the question. How will you treat the revaluation loss? And you know what? Almost all of you will make this mistake. You will say, sir, I have a revaluation reserve balance of 240. So what I will do? The entire loss of 200 will be adjusted with revaluation reserve. And that's where you will make a mistake in the exam. Why? Because you would have transferred a portion of revaluation reserve to retained earnings over the 3 years. So the balance of revaluation reserve here will not be 240. It will be something less. What? So 240 was the balance originally. Every year we will transfer from revaluation reserve to retained earnings by amount of excess depreciation. What is the excess depreciation? 120 minus 90. How much? 30. So 30 into 3 is how much we transferred to retained earnings. Revaluation reserve to retained earnings. So 240 minus 90 is 150. So the balance of revaluation reserve. So here you can write on this date, the balance of revaluation reserve is only 150. So if you have a loss of 200, you can adjust only 150 with revaluation reserve and the rest 50 has to be transferred to P and L. So this is the concept where I see a student generally making a mistake in the exam. Is that clear, everyone? Come on, guys, please tell me. Is that clear, everyone? Is that clear to all of you? Come on, guys, please tell me. Clear to all of you? Wonderful. Let's move further. The depreciation. the depreciation. How do we depreciate the property, plant, equipment? So depreciation starts from the date when the asset is available for use. Again here, students will make a mistake. Again here, the students will make a mistake. So depreciation starts from the date when the asset is available for use, not from the date when it is actually used. No. Let's suppose I purchased the calculator today. Can I use this calculator? Yes, I can use it. So it is available for use. But I didn't use this calculator for 3 months. Comes the question. For these 3 months, will we depreciate? Yes, we will depreciate. Yes, we will depreciate because the calculator was available for use. It doesn't matter whether you used it or not. It doesn't matter whether you used it or not. Okay, now. So depreciation should starts. See here. Okay, when the asset is available for use. When does depreciation cease? When the asset is derecognized or is classified as held for sale under IFRS 5. Under IFRS 5. Okay, now depreciation does not cease when the asset is idle. Like for example, I said I was not using this calculator, but still you will charge depreciation, or it is retired from active use. Let's suppose I have a bike. I have a bike. Okay, I am not using that bike now. I am not using that bike now. Will we depreciate it? Yes, I will still depreciate that. Okay, doesn't matter whether I am using that asset as of now or not. It will depreciate. It will be depreciated over the useful life. How to depreciate? So we depreciate the depreciable amount of the asset. We depreciate the depreciable amount of the asset. How to calculate depreciable amount? So depreciable amount is cost of the asset minus residual value. This is what we have to depreciate. How? Over the useful life of the asset. Over the useful life of the asset. Sir, where do we need to recognize depreciation? So depreciation is ideally recognized in P&L. Okay, but if I am using this asset for construction of some other asset, then in that case, the depreciation of this calculator, the depreciation of this asset is capitalized to the cost of that asset rather than expensing it off to the P&L. Okay. Now, what is component accounting? Understand the meaning of component accounting. Understand the meaning of component accounting first of all. So understand the standard says that if there is an asset, let's suppose aircraft. Okay, generally aircraft has a life of 20 years. But the engine of the aircraft has a life of 5 years. And understand, if the cost of aircraft is 100 million, the cost of engine is 30 million. So significant cost. So the standard says that if the life of a component of the asset, is significantly different from the life of the main asset. The life of aircraft is 20 years. The life of engine is 5 years. Then depreciate the component separately from the main asset. Meaning thereby, I will depreciate the engine over 5 years and I will depreciate rest of the aircraft. Over 20 years. Okay. This is called as component accounting. Each part of an item of property, plant, equipment with a cost that is significant in relation to the total cost of the item. Cost that is significant and having a different useful life should be depreciated separately. Components should be identified at initial recognition. Okay. Now, so this is the meaning of component accounting. Now, what is derecognition? Now, the standard goes on to state when you dispose, that is when you sell the asset, derecognize the asset. When you sell the asset, derecognize the asset. Or when from the asset there are no further economic benefits available, then also derecognize the asset. So basically, when you dispose of the asset or when there are no economic benefits available from the asset, we should de-recognize the property, plant and equipment. What is the journal entry on de-recognition? Can you please tell me the journal entry on de-recognition of the asset? So journal entry will be equals to bank account debit by the sale proceeds to asset, to property, plant, equipment at its carrying amount, and any difference goes to P and L as gain or loss on sale of asset. That's what I have written here. See, gain or loss, that is sale proceeds minus carrying amount arising on derecognition of PPE is recognized in P and L. Okay. Now, on derecognizing, if you have any, on derecognition, if you have any balance in revaluation reserve for that asset, if you have any balance in revaluation reserve for that asset, it should be transferred to retained earnings. See, this point is coming from here. On derecognition of the asset, whatever is the revaluation reserve transferred to retained earnings. That's what I'm writing here also. See, on derecognition of the revalued asset, any credit balance in revaluation reserve is transferred to retained earnings. Is it clear, everyone? Is it clear, everyone? Chalo. Okay, Paul wants to see that question again. Yes, you can see that, Paul. Now, subsequent costs. What is the meaning of subsequent costs? What is the meaning of subsequent costs? Costs incurred. Sreen, yes, this file will be shared with all the enrolled students in the Google Drive. Costs incurred during useful life. Okay, I'll write here. Just a minute. Subsequent cost means costs incurred during useful life or costs incurred after the asset reaches its intended location and condition. Okay, now understand here. So standard says that if there is any cost that is incurred after the asset has reached its intended location or condition, will you capitalize that cost? So standard is saying if that cost increases the economic benefits, you will capitalize that. Okay. Now, see, understand, repairs and maintenance, does it increase the economic benefits? No, it just maintains the economic benefits. Okay. So day-to-day servicing or repairs and minor replacements, okay, they are expensed off to P&L. But if you incur any inspection costs, if you incur any replacement costs, they are capitalized to the cost of the asset. Now understand, let me explain the example. Let's suppose an aircraft is supposed to undergo an inspection every 4 years. Without which it cannot operate. So let's suppose in this year we have incurred the inspection costs. So this inspection cost increases the economic benefits. Why? Because this inspection cost enables the flight to be operated, without which the flight will not operate itself, right? So this inspection cost has to be capitalized to the cost of the asset, and depreciated over the 3 years or 4 years, whatever is the useful life of the inspection cost, We have to depreciate over that. Now, replacements. The wonderful example is component accounting. Let's suppose, as I was mentioning, the life of the aircraft is 20 years, but the life of the engine is only 5 years. Then after 5 years, the engine will definitely has to be replaced, right? Definitely we cannot say that aircraft itself has to be disposed of. No, what I will do, I will continue with the aircraft, but I will replace the engine. So what will happen? The old engine has to be removed, the new engine has to be capitalized, right? Has to be capitalized, has to be installed in the aircraft. So whatever are the cost of replacement, it has to be capitalized to the cost of the asset. Okay, now I have taken up an example for this also in the replacement accounting. See here, A Limited acquired a heavy machinery at a cost of $100 million. Okay, turbine costing 30 million and rest of machine costing 70 million. So machine was purchased for 100 million. There were two components, turbine of 30 million, okay, and rest of the machine for 70 million. The estimated useful life of machinery is 10 years. However, the life of turbine is only 4 years. So life of turbine is 4 years and the rest of the machinery will have a life of 10 years. At the end of third year, the turbine requires a replacement. At the end of 10 years, the turbine requires a replacement. The remainder of the machine is perfect and is expected to last for the next 6 years. So it says at the end of third year, the turbine has to be replaced. The turbine has to be replaced. The turbine has to be replaced. Okay. The cost of new turbine is 45 million. Okay. Now what is the accounting treatment? So now tell me, I will depreciate turbine over 4 years. I will depreciate rest of the machinery over 10 years. So for these 3 years, what will be the depreciation? For turbine, 30 is the cost, 4 years is the life, 3 years we have to depreciate. So depreciation is 22.5. So what is the carrying amount here? 30 minus 22.5 is 7.5. Clear? For rest of the machine, cost is 70 million, life is 10 years. We have to depreciate over 3 years. So 70 by 10 into 3 is the depreciation is 21. So what is the carrying amount? 70 minus 21 is 49. So what is the total carrying amount? 7.5 plus 49 is 56.5 is the carrying amount. Now, turbine has to be replaced. So I will de-recognize the old turbine and I will recognize the new turbine. What is the cost of new turbine? 45 million. Right? So I will recognize new turbine at 45. Revised carrying amount will be 56.5 minus 7.5 plus 45 is 94. Now comes the question, what is the journal entry to record these? So turbine, to de-recognize the old turbine, reduce the value of machinery, and 7.5 is an loss for us. So transfer it to P&L, transfer it to P&L, transfer it to P&L, de-recognize the old component. Recognize the new component, machine account debit to bank 45. Is it clear? This is called as component and replacement accounting. Tell me guys, is it clear everyone? Is it clear everyone? Okay, chalo. Now comes the next part, modes of acquisition of property, plant and equipment. So there are 3 modes of acquiring. One is the purchase, one is the self-constructed, one is the exchange. Self-constructed. So standard says that, see, purchase already we have discussed. That is the cost, purchase price plus non-refundable taxes minus trade discounts, right? Plus directly attributable cost plus borrowing costs, right? Then plus provision for decommissioning, removal or restoration cost. So purchase we have already discussed. Self-constructed. Standard says if you construct the asset yourself, the principle is exactly same as purchase, but you have to take care of few things. You have to take care of few things. And what is that? Same measurement principle as discussed. However, the cost of abnormal amounts of wasted material, labor and other resources incurred in constructing the asset is not included in the cost of the asset. That is, abnormal waste is recognized in P and L. Sir, what is the meaning of abnormal waste? Let me give you an example of abnormal waste. So let's suppose what happens, I want to construct a building for myself. Okay, for that I ordered cement. Okay, now what happened, when I order cement, in transit, some cement will definitely go waste, and I cannot avoid that. It is called as normal waste. Something which is unavoidable is called as normal waste. But what happened? One of the worker, okay, theft. One of the worker took away two bags of cement with him to his home. This was an avoidable loss, right? It is called as abnormal. Loss. We cannot capitalize this. So standard is saying if there is any normal loss, it can be capitalized to cost of PPE. If there is an abnormal loss, it cannot be recognized in PPE. Now, PPE acquired in exchange. Okay, PPE acquired in exchange. Now understand, see, there are 2-3 topics. These 4 topics basically, they are not ideally tested in the exams, but still it is in your book. So I don't want to leave on that. But I will discuss it quickly. Now tell me, let's suppose I purchased this calculator. And paid $20. Tell me, what is the cost of this calculator? $20, because that's what I have paid. But now understand, I purchased this calculator, but I don't have cash to pay. What I did is I paid via some other asset. Then what is the cost? The asset that I gave. Is my cost. So standard says that if you acquire an asset in exchange, means you took one asset by giving one asset, then in that case, the cost is the fair value of the asset given up. The asset that I gave it to you, the fair value of this asset is the cost of the asset that I acquired. So recognize PPE at fair value of asset given up. If you want me to take up an example, I can definitely take it up. Let me just wait. Just give me a minute, please. See here. A acquired an building carrying amount 100 by giving a warehouse. Fair value, not carrying amount. Fair value is 200 and carrying amount is 180. Carrying amount. See, because this I have given this warehouse, so means I owned the warehouse. Earlier, but to acquire the building, I am giving my own warehouse. So what will happen? I will recognize the building. At what value? Fair value of the warehouse given. At what value? What is the cost? So what I have given? Warehouse. What was the fair value? 200. So I will recognize building at 200. Now, since I have given the warehouse, so I have to de-recognize the warehouse because I am no more the owner of warehouse. So I have to de-recognize the warehouse. I will de-recognize the warehouse at its book value. What is the book value? 180. Difference goes to P and L 20. Clear, everyone? Chalo. Incidental operations. What is the meaning of incidental operations? So understand, standard is saying, let's suppose I wanted to construct a shopping mall. But till the time shopping mall was under construction, I utilized that place for parking of the cars. For car parking. Now, to make that place suitable for car parking, I incurred some cost. And when the car parking started, I got some revenue from car parking. So now the standard is saying that this car parking was not my main activity. It was not my intention to make it car parking. The intention is to make shopping mall, right? So standard is saying whatever is the cost incurred, and whatever is the income that you earned from this car parking, everything should go to P and L. Everything should go to P and L. Use of the building site as car parking until the construction starts. The cost of constructing car park and income earned are to be recognized in P and L. Enabler assets. So standard says that these assets do not have any economic benefits on their own, but these assets enable the main asset to be operated. Okay, like for example, government has come up with a regulation that all the factories in this locality should have a safety equipment available. A safety equipment available. A safety equipment available. If there is no safety equipment available, you cannot operate the factory itself. Now tell me, from the safety equipment, am I getting any revenue? Am I getting any economic benefit? No. But if I don't install the safety equipment, will I be able to operate the factory? No. Will I be able to operate the factory? No, I will not be able to operate the factory. I will not be able to operate the factory. So this safety equipment enables the factory to be operated. Okay, so even though this safety equipment doesn't have any economic benefit of its own, still it has to be capitalized to the cost of the asset. Still it has to be capitalized to the cost of the asset. Okay, spare parts, standby equipment or servicing equipment. Okay, now standard says that, like for example, fire extinguisher. Like for example, I have kept a separate laptop. Let's suppose this laptop goes off for some reason. I have kept a separate laptop so that I can take class in that laptop. That is a spare asset, right? I have taken a fire extinguisher. That is a standby asset. Okay. Servicing equipment like tools, equipments to repair the machineries. So standard says that all these spare parts, standby equipment, if they satisfy the definition of property plant equipment, then they has to be recognized as property plant equipment. If they don't, then they has to be recognized as consumables in inventory, that is IAS2 inventories. Okay. Now, moving on to disclosure requirements. So what all we have to disclose? We have to disclose whether we are using cost model or revaluation model. What is the method of depreciation, SLM, WDV, production units method, machine hour rate method? What is the useful life of the asset? What is the opening gross block of the asset? What are the additions or the deletions that we have done during the year? What is the closing gross block? What is the depreciation charged? What is the revaluation done during the year? What is the opening and closing depreciation? How many assets are classified as held for sale? What is the opening and closing net amount of the asset? All these things has to be depreciated. All these things has to be disclosed in the notes to accounts. Now what I have done here is I have given you a list of the asset. Okay, so what I did is I analyzed all the questions that has been asked in the exam, whether as part of anything. Okay, now, and these were the common points where the examiner tests your knowledge. So I have made a summary. Whether cash settlement discount can be capitalized? No, so P&L. Trade discount reduced from cost of asset. Refundable taxes, no treatment. Testing cost of asset. Proceeds from sale of output produced during the testing of the asset, P&L. So meaning thereby, when you incur any testing cost, that has to be capitalized to the cost of the asset. But while testing, if any asset is produced, if any goods are produced and you sell that goods and earn revenue, what is the treatment of the revenue? That will go to P&L. Okay. Pre-product testing, cost of the asset. If you purchase 5-year maintenance contract, prepaid expense and amortized to P&L. Okay. Professional fees, cost of asset. Employment cost of asset. Staff training cost, if you have incurred any staff training cost, that will go to P&L. There are other costs also that will go to P&L. See here, staff training, P&L. Cost of opening a new facility, P&L. Relocating the asset, if I have an asset here, I am relocating to some other premises, the cost of relocation, can I capitalize? No. Cost of introducing a new product, can I capitalize? No. Cost incurred after an item is capable of being operated in a manner intended by the management, means cost incurred after the asset reaches its intended location and condition. Can we capitalize that? No. Operating losses, can we capitalize that? No. General overheads, admin overheads, distribution overheads, allocated overheads, can we capitalize it? No. Okay, now some common mistakes which student does in the exam. Okay, cash discount, what is the treatment? P&L. Overheads, allocated overheads, P&L. Directly attributable overheads, capitalized to cost of PPE. Testing cost, sale proceeds of goods in the testing phase, recognized in P&L. Non-refundable taxes. Understand, if the question is silent, assume it to be non-refundable. If the question is silent, assume it to be non-refundable. Revaluation reserve. You remember, I discussed this point of revaluation reserve, right? Transfer of revaluation reserve to retained earnings over remaining useful life of the asset by amount of excess depreciation. Only if the question mentions, note the transfer has to be done from revaluation reserve to retained earnings and no impact on depreciation. I have discussed the detailed example of this one. Depreciation, diminishing balance and reducing balance and WDV method, all of these are same. They are just the synonyms of one another. Okay. So I believe with this we have revised the entire property, plant and equipment, but there are some queries in the chat box which I want to take it up again now. Sneha has a query. Can you explain the exchange of assets part again? Definitely yes, Sneha. See, under exchange of assets, if you know the principle, tell me what is the principle of capitalizing the asset. What is the principle? The principle is capitalize the asset at its cost. So if I have purchased the asset and paid the cash, so whatever cash that I pay is the cost. But if I have not paid cash, rather than cash, I paid this asset. So this asset is the cost of acquiring this asset. This asset is the cost of acquiring this asset, right? So I will have to recognize the building that I acquire at the value of the asset that I gave, fair value, that is 200. So the building that I acquire is recognized at fair value of asset given up. Clear, everyone? Now, one more query from Chirag. Can you explain the depreciation capitalization part again? Okay, let me explain. Let's suppose I have a machinery. Have you seen that that machinery which grinds and mixes the cement, the stones and the water so that you can use it for construction of the building, right? Right? So that machinery, let's suppose, has a life of 5 years. So definitely we have to depreciate that machinery. Okay, but tell me, where do we use that machinery? To construct a building. So standard says that depreciation of that machinery is to be capitalized to the cost of the building. Why? Because that machinery was used to construct the building. So any cost incurred to construct that building has to be capitalized to the cost of the building. Clear? Clear, Chirag? Is that clear, Chirag? Okay, wonderful. So we are keeping today's session till here. Again, tomorrow we are meeting. Tomorrow again we are meeting, and tomorrow we will be again revising. Tomorrow again we'll be revising the next chapters from here. Okay, we'll be revising the next chapters from here. Okay. I believe all of you would have enjoyed the session. And I request all of you to please drop a comment, feedback in the comment box. Also, if you want to enroll in this revision course, which will have the practice, just a minute. See here, which will have the revision of all the concepts, the practice of the questions, the mock test, the discussion of all the mistakes which you could do in the exam, the examiner report analysis, all these things you can enroll in this batch. Okay, now how to enroll? The link of enrollment is given in the comment description of this video. If you want to connect with our team to understand some of the, like what exactly is the pricing or what are the offerings, if you want to understand in detail, the contact number is also given. You can call our team, they will guide you, you can enroll accordingly. Okay, I believe you would have enjoyed the session. Thank you guys, bye bye.